Hi, my name's Toby Mathis. I'm an attorney, an entrepreneur, and an investor. Today I'm going to be talking to you about tax planning. There's three big categories. There's asset protection, tax planning, and estate planning. Tax planning to me is one of the most important ones, if not the most important topic. So I'm going to be going over 5 main areas with you today. First off, the importance of tax planning. Second off, we're going to be discussing some hot buttons in some areas that the IRS is really scrutinizing. Number 3, we're going to be talking about expenses that you may have incurred prior to your workshop that you're going to want to make sure that you categorize. Number 4, we're going to be talking about IRS books, what they mean, what P&Ls are, what balance sheets are, and how easy it is to maintain them. And number 5, we're going to be talking about corporate credit and how easy it is to build an asset inside of a business. So let's jump right into number 1. First off, in addition to being a partner with Anderson Law Group, I'm the president of Boss Business Services. We file thousands of tax returns, have clients all over the country, and do a lot of the business compliance work like bookkeeping and making sure that the businesses are staying up to speed with regards to legalities. The tax planning goes hand in hand with those areas. And so we oftentimes are asked, why is tax planning so important? And one of the easiest ways I can explain it is by giving you some contrast. We're going to use taxpayer Bob and taxpayer Peggy. Bob is an individual, Peggy is a business. Bob goes to buy a laptop for $2,000. Peggy goes to buy a laptop for $2,000. Bob, the individual, has to earn $2,700, about average, to make a payment of $2,000 for that laptop. In other words, he has to earn money, and then he has his federal taxes, his state taxes, his Social Security, FICA, etc., reducing that amount so that he has $2,000 left over. Peggy, on the other hand, goes right on in and she buys the $2,000 laptop. Guess how much she has to earn in her business to buy the laptop? $2,000. The difference is a whopping $700. Same thing, we have Bob and Peggy. Bob wants to go and take a bunch of seminars on real estate investing, go to some conventions, meet with some mentors to continue on learning about real estate investing. He spends, between travel and the cost of the classes and everything, about $27,000. In order to make that payment of $27,000, Bob's going to have to earn somewhere in the neighborhood of $35,000 so that he has the leftovers to pay for those classes. Peggy, on the other hand, does the exact same thing. Has a bill of $27,000 and her business pays pretty close to the exact amount, $27,000. There's a pretty big difference there, folks, $7,000, $8,000. Last example, Bob, the real estate guru, has a bunch of properties that he's developed and he has some properties that he's held. He decides to sell one of the older properties, makes about $200,000. He decides to do it on an installment sale. Heck, it's tough to get credit nowadays, so he carries the note. He goes to his accountant who says, Bob, I'm sorry to tell you this, but you're going to have about a $50,000 plus tax bill. Bob says, well, I haven't made the money yet. And the accountant says, I'm sorry, but there's something called dealer status that's going to impact you. You're going to have to pay the tax now, even though you haven't received the money. Go back over to Peggy. She's doing the exact same transaction. She has a close to identical portfolio, and she sells the $200,000 property, makes the $200,000 of gain, but her tax bill is close to zero under that installment sale. The accountant talks about, hey, you're deferring the revenue to recognize it over a longer period of time and you have long-term capital gains. What's the difference between those two people? It's tax planning. And what it really boils down to is that individuals and businesses and different types of income are treated differently. And that's going to be a very important concept for you to learn at the event. Now, Mr. Coons used a matrix of sorts, and I'm going to use that as well to kind of explain how tax planning works. You have an individual category up here, and you may have things like your W-2 income, you may have IRAs, all these things impact and change the taxation in that particular category. You have active businesses down here, and lo and behold, there's differences in how businesses are taxed as well, depending on how they're categorized and what type of income you have, which we're going to have to go over and explain the different types of income, which we'll do in a second. We have our non-risk assets up here, which oftentimes, almost always, are going to be passive or investments, and so we want to make sure that our non-risk assets don't get bled over into other categories. And we have our risk category, and this is really real estate. And there's a huge difference depending on how you categorize real estate that we might want to be cutting this section up. And we're going to go over that in a minute. In order to really engage in tax planning, you have to understand kind of the broad strokes of what we're really talking about when we talk about income and expenses, and that there's actually various categories. One of the most difficult concepts for any tax professional to understand is that the IRS doesn't just look at income and think it's all the same. They have different types of income. And really, there's three broad categories. First off, income is really whenever you receive a wealth transfer, with the exception of things like gifts and inheritance. You don't have to pay tax on those. Everything else kind of falls into the category of, hey, this is income. Underneath that big heading of income, we have three categories. The first one is earned income. Earned income is subject to something called Social Security tax. It's FICA. It's old age and disability. The Medicare portion adds up to about 15.3%. Fluctuates a little bit depending on what Congress is doing. Sometimes they give a little nudge to the employer portion or to the employee portion that they may be able to keep a little bit more in their pocket, but it's always around 15.3%. That gets added right off the top. Every dollar is going to be subject. There's a phase out at about $100 and some thousand, where if you start earning over that, then portions of it phase out, like the old age and disability portion. But other portions stay on forever, and they're even talking about surcharges, depending on if you make too much money of earned income. Number two is we have investment income. This is an area that is of critical importance to most folks. You have things like royalties. You have things like capital gains. You have dividends. All of these are investment income. And then you have a category called passive income. Passive income, the big category that you guys are going to be aware of, is rents and non-material participation in business. I'm not going to confuse you with all these things. Just know that they're out there. The type of income really determines what we can do to control that income. And there are definitely things that we can do to control income. Number one is we're going to talk about decreasing income. Now that may sound ominous. Hey, I don't want to make less income. But you personally may want to make less income. We may want to defer some of the income over to relatives, maybe to retirement plans. Maybe we want to have entities that receive income and are paying tax at their bracket. You may want to just modify your income, and it's an effective technique. Number two, we may want to transform taxable income into non-taxable income. How do you do that? You mean that I could actually choose whether or not the income I receive is actually taxable or non-taxable? Absolutely. There's things like renting your house where you may have things that are not even reported under your adjusted gross income so long as you meet the rules. We absolutely want to take advantage of that one. Number three, we may want to defer income. Now you guys are all probably familiar with IRAs, things like that, where you may be paying tax in the future. Deferral is a fantastic way to do some tax planning now. Depending on how old you are, or what type of job you have, or whether you're already in another business, you may not want to add more dollars onto your income tax bracket now. You may want to defer it out to where you may not have the type of income. Or I've seen a lot of folks where they had installment sales where they were getting large amounts of revenue over a short period of years. They didn't want any more income landing now. They want to defer it out as far as humanly possible. You'll learn techniques to do that at the event. Number four is you can reclassify. And this is a big one. And you're going to learn this at the event. For example, if I, as Toby the attorney, go out and make a bunch of money in my name, it's all going to be subject to self-employment tax. It's all earned income. Maybe I want to use an S-corp so that I don't have to pay self-employment tax on the whole amount. There's other vehicles that you can use to make sure that all that income isn't flowing directly onto your earned income, and maybe we can save some dollars that way. Is it legal? Absolutely, and you're going to learn absolute white hat ethical ways to minimize your taxes by using these types of controlling income strategies. Now let's talk about one of the big areas and one of the major benefits you're going to get out of going to the workshop, and that is when dealing with expenses. There's no real definition of expense, but if we use the alternative or the alternate of income, we'll just say it's transferring wealth to another party. And the question is whether it's business or personal. If it's a personal expense, you have very few that are deductible, which means reduce your income and reduce the amount of taxes you pay. Your personal deductions may be like a mortgage interest deduction. You may have some personal expenses that are medical that maybe you're able to deduct if you go above an adjusted gross income floor, things like that. But more often than not, the only way you're going to get true tax relief is by utilizing business deductions. And what are business deductions? In its simplest term, it's ordinary and necessary business expenses in a trade or business. It's something that you incur in a trade or business. And so you got to have that trade or business. And so you're going to learn at the workshop of how you can take what you're doing in your activities and start to work with them so that you can classify and reclassify expenses that would be personal into business expenses. And yes, quite often it is as simple as a choice. We're going to be going over really 4 main areas again to control our expenses. Number 1, we're going to make non-deductible expenses into deductible expenses. For example, as an individual, if I go to a seminar or a convention, I don't get to write it off. As a business, I do. That's going to be a big one for you guys. That's why we want you capturing all your expenses and keeping track of certain things, because we may still be able to salvage some of this. Number 2, transfer. Transfer the expense into a more favorable form. For example, if I am a person and I incur medical expenses, I may be subject to an adjusted gross income floor, whereas if it's a business that's reimbursing me, there may be no adjusted gross income floor. One case, I don't get to write off much of the expense. The other case, I get to write off 100%. So we're going to be exploring and discussing ways that you can take expenses that otherwise you wouldn't get the benefit for and making them into something that you do receive some benefit for and some tax relief. Number 3 is acceleration. And here's how it works. If I have something that is being depreciated, in other words, I don't get to write off a property in the year that I buy it. Maybe I buy a piece of equipment and I don't get to deduct the entire value. Maybe it's over 5 years. There are things like bonus depreciation, or there's cost segregation rules where I can take things that are depreciated over a set timeline and accelerate that. So let me give you an example of a piece of equipment. Maybe I have 100% bonus depreciation like we had in 2011. So I go out there and I buy a piece of equipment. I don't come out of pocket much, maybe I even finance it, but it may be something that generates me a massive deduction of $100,000. Can I take that? Absolutely. As long as you follow some simple rules, you can take advantage of those types of things. So it's accelerating that deduction. It's not letting it be spread out over time. Number 4, and this is probably our favorite one, is reclassifying certain personal expenses into business expenses. And let me explain how this works. If I go out to lunch with a potential client and I pull out my credit card and I pay for lunch, that's a personal expense unless I take certain affirmative steps to classify it as a business expense. And that's how you reclassify personal expenses into business expenses. I take things that otherwise, hey, I went to lunch, I met with a client, yeah, I paid for a sandwich, big whoop. Well, maybe I want to be able to write that off. And over a year, it could actually add up into a substantial amount of money. So I want to take things that would ordinarily be personal and I want to reclassify them into business, so long as it's ethical and I meet the guidelines and the requirements. Same thing with things like mileage. Hey, I'm driving here too. Maybe I'm stopping off and looking at properties, maybe I'm looking at some of my rental properties. I should be classifying that from a personal, which is ordinary, is just a personal expense and I don't get to deduct it, into a business expense. And so we're just taking one little step, an affirmative step, to make sure that we're writing that off. In other words, deducting it against our income, which is going to lower our tax bill. You're going to learn a whole bunch of those at the workshop. At our workshops, we like to focus in on what we call hot button issues for the IRS. First off, remember that the IRS is a collection agency, kind of a policing agency for the Department of the Treasury. They're out there collecting the taxes. And like most agencies, they want the biggest return for the least amount of effort, the biggest bang for the buck, so to speak. And so they identify areas, usually through the Government Accountability Office doing audits, where they determine that, hey, there's a lot of mistakes being made over here, or taxpayers may be abusing the code over here. And one of those areas is something called real estate professional. And when someone's claiming real estate professional status or is involved in real estate activities, there's a greater than 50% likelihood, according to the Government Accountability Office, that there may be errors on that return. So that's where they're going to focus. So as a taxpayer, what do? A, we look for the hot buttons. We look for the areas where they're auditing the most, and there's always going to be stats that are published to allow us to identify those areas. And then we make sure, absolutely certain, that our clients are in compliance so that they can maximize their tax relief without running afoul of any of the rules. So the easiest thing to do is to understand the rule completely and then make sure that your activities are set around making sure that you're compliant. To understand the rule is the big step number one. And the rule that we're talking about with real estate investors, you have to go back in time to 1986 and talk about when the passive activity loss rules were brought into being. Prior to 1986, you could take all of your losses and offset and use them to deduct against your other active income. And in 1986, they said, hey, you know what, there's a lot of abuses, there's these tax shelters, there's all this stuff. We're going to limit the amount of loss you can take on passive activities to $3,000 against your active income. In other words, if you have passive income and you have passive losses, they can offset. You have more losses because of things like depreciation, etc., then that amount can only offset up to $3,000 of your active income, and you can carry forward the rest. Now, there's two exceptions that they created. One is the real estate professional status, which is material participation. And number two is active participation. Active participation, as you'll learn in the workshop, you can write up to $25,000. It phases out when your adjusted gross income hits $100,000 on up to about $150,000. It'll be gone. And so a lot of folks and a lot of taxpayers and their professionals start zeroing in on this real estate professional activity. And there's some rules that you have to follow. And the easiest thing you can do is go look at the audit guides that the IRS uses and what their auditors are going to be asking, and just make sure that before you ever claim anything, that you meet the guidelines. It's actually fairly straightforward. Where you need to have 750 hours and it has to be more than half of your service hours that you put in during the year. So let's put this in English. And it can be either the spouse or the taxpayer themselves as well. So if you're married filing jointly, then one of you has to qualify in order to be a material participant. And again, we're going to go over all this stuff at the workshop. But the IRS knows that if you are working a job and you're trying to claim that you are materially participating in your real estate, that you're going to have a very high hurdle to get over, because you may very well be spending over 750 hours in real estate, but are you putting in more time in your real estate activities, in not just real estate activities, but materially participating in your real estate activities than your other job? And more often than not, the answer is no, unless you have another spouse. And this is another technique that we'll be talking about in strategies, unless you have a spouse that is going to qualify from their time. And so those are things that you're going to be addressing at the workshop. So once we know what the issue is, it's very easy for us to go through and determine whether or not a taxpayer is actually eligible, so long as they're working towards that goal. So if you came to the end of the year, you went to your tax professional, and then they said, oh, this is something we may want to look at, but you haven't been keeping records, you're going to be dead in the water, because that material participation test is a year-by-year test. You have to do it every year. You don't want to go back in and be recreating. So you're going to learn at the workshop the type of activities that you need to be documenting, what exactly will qualify you, and also ways that you can actually maintain proper records so that if you do qualify, then you can use that, because it's a massive tax saver if you're able to take your real estate losses and offset all of your other income. I mean, think if your spouse is making W-2 income of a couple $100,000 a year, and now all of a sudden you know because you qualify, and you know, ironclad, I qualify as a real estate professional, that the more real estate I gather, the more tax savings we're going to get. It's another factor that helps you make more profit and make better decisions in your other investing. So it's absolutely something you want to be considering as you go forward and as you do tax planning. The next area I want to go into is expenses that you may be incurring prior to the event. This is a big one. When we go to workshops, quite often folks have not been keeping good records of the things that they're incurring in their trade or business or in any of their endeavors. You'd be shocked, or actually maybe you wouldn't be shocked, at the lack of bookkeeping that some businesses have. We're talking $1 million plus businesses, and quite often they don't even have a profit and loss. And so I want to make sure, and we want to make sure, that all of the attendees in the workshops are gathering their expenses. In the materials, I'm going to include a monthly tax tracker that's going to have the types of expenses that you're going to want to track. But in the meantime, let's go over some of the big ones. First off, the expenses you incurred for seminars. The travel expenses that you incurred going, and that could even be things like mileage logs. Write down how many your odometer before, your odometer after, when it occurred and what it was for, things like that. And again, in the materials there will be a mileage log so that you can just use ours. You're going to be talking about hotel receipts. You're going to be talking about meals and entertainment. Any filing fees, things that you incur, make sure that you're documenting those. Receipts is pretty good. Even better on certain things is writing out what they're for on the receipt or keeping track of it in some sort of notebook. Again, you can use the materials that we provide. Cell phone use. Internet access. Consulting fees. Including mentoring fees, things like that. Attorney's fees, my favorite. Software expenses. Management fees. Interest paid on credit cards, etc. You get the idea. Start documenting these things, because quite often people are shocked at how much money they're leaving on the table. Further, at the workshop, you're going to be brought up to speed on certain, what we call kind of areas that are common areas that are misunderstood, where people miss out on deductions. And our tax department can actually help make sure that if you've missed out on some things in the past, that they can review, spot them for you, and about half the time we find money on people's returns. It's actually, once you start looking in this area and the way that business taxes work as opposed to personal taxes, and some of the misconceptions, and we clear that up, you're going to be surprised at how many mistakes there's actually made. Now let me give you a stat, and this is not from me, this is actually from another IRS report that was published within the last year. And what occurred was chain tax preparers were basically given a set of a scenario that was kind of fake. It was government agents go in with a certain scenario to see whether or not the chain tax preparers are accurate. And when they did business returns, the accuracy rate, and I'm not kidding, was 0%. They made errors on every single return. So the Treasury Inspector General goes out and does another test and says, let's take a look at some of the smaller tax preparers. We're not talking necessarily about CPA or enrolled agents, which I'll go over the distinction between those in a second, but we're talking about, unlicensed, which is the vast majority of tax professionals out there actually are not licensed and haven't even had to pass a competency exam. There's 4 states out of the 50 that actually have anything in place, although the IRS is going to be curing that in the coming years. But anyway, so they went to these places and they found that the accuracy rate for business returns was 8%. 92% had errors. So what does that tell you about common knowledge of business expenses? If you don't go to somebody that does businesses and does tax work and compliance work for a business constantly, chances are you're going to get erroneous advice. The IRS is not lost on them. They know this as well, and that's why you see sole proprietors They're almost always going to have the highest audit rates because it's the low-lying fruit. Because guess what? If you're not dealing with a CPA and attorney, chances are you're going to be operating as a sole proprietor, because the guy down at H&R Block might just say, hey, it doesn't really matter to me how you're structured. Whereas if you go to somebody that's a planner, they're going to say, hey, from an asset protection standpoint, you might want to change things. From an estate planning standpoint, you might want to change this as well. Oh, and by the way, there's some tax benefits as well. And so chances are you would make a shift at that point. Now let's talk about tax professionals, because they're not all created equally. There's actually a state license, like a CPA, where you're licensed by a state, and that's not a tax preparer. That's actually a certified public accountant. They're really very good at doing, books and things like that in some of the bigger companies and making sure that the financials are accurate. And then you have a federal license called an enrolled agent, where they do nothing but tax forms, tax preparation. Then you have the whole group of non-licensed tax preparers. Now, there are some attorneys out there that do tax prep work and things like that. They're okay. But it's the unlicensed folks that really cause concern, because you don't know the criteria and the qualifications of this person or how they got trained. They may have gone to a 6-week course at one of the chain preparers and decided that now they're going to be a tax preparer, and they really don't know all the ins and outs and the nuances with regards to businesses. So beware. Beware of where you get your advice, and make sure you're talking to somebody, a professional, who actually does what you do. One of the biggest differences between attorneys that practice in a particular area where they have experience and where they don't is just that, hey, that street knowledge of what's going on. I invest in real estate, my partners invest in real estate, my partners run businesses, I run businesses, I know the ins and outs, I make payroll, I do all those things. I understand and can empathize with where a client's coming at much better than somebody that may not have that background and experience. And it's no different when you're talking about tax professionals. Make sure that that's what they do, because if you do it and they do it, then they're going to already know a lot of the nuances for exactly what's going to affect you, and make sure that, hey, they're going to do the same things for you that they're doing for themselves, right? They're going to make sure that, hey, if you could qualify as a tax professional because you're going to get all these deductions that you wouldn't otherwise get, or you're going to be able to offset income that you wouldn't otherwise be able to offset, then here's the criteria. They already know what that criteria is because they're doing it for themselves. And so they're going to have a much better idea of what is necessary for your business returns as well. The next area I want to discuss is proper bookkeeping. There's a legal requirement that we maintain books and records. A lot of folks don't realize it because it's not necessarily defined. The IRS says track your income, track your expenses. For a business, this is absolutely critical. As an individual, you may have a check register, and you may determine, hey, that's good enough. I can tell because I don't really have that many personal expenses that are going to be deductible anyway. I only have to know what those are, and usually somebody's sending me a statement, right? They're going to send you your mortgage statement at the end of the year so I can write that off. For a business, it's far more different because you're not necessarily getting 1099s from everybody. You can't rely on them, plus you're not allowed to rely on them. So you actually do a degree of bookkeeping. The most common statement is a profit and loss statement. And all that is, it's a statement of your income and a statement of expenses. And I'm going to put up on the board here a sample profit and loss statement. And let's go over some of those sections. For example, this is just a QuickBooks standard chart of accounts where we have some management fee income, we have sales, and then we have all these expenses. We have things like the cost of goods sold, advertising and promotion, amortization expenses when we're writing things off over time, bank service charges, interest expense, payroll and delay. There's just a laundry list here that gets us to our net income, which is our bottom line. And that's what a lot of folks stop at, which you can't. You really need to take a look at your balance sheet as well. So when you hear about someone saying, hey, what's a typical financial for a business, or I want your business financials, if you hear a banker say that or ask for that for a business, they're usually going to be asking for a profit and loss and a balance sheet. A balance sheet, in its simplest terms, is a statement that says, what are my assets, what are my liabilities, and what is my shareholder equity or my ownership equity in that account. And let me just write this up on the board before I show the chart of account for you. But in its simplest terms, assets equal liabilities plus shareholder equity. Okay. In English, what that means, if I have an asset like cash, it has to equal the amount of my liabilities, which if it's zero, let's say I have $10,000 in the account, it's going to equal my liabilities plus the shareholder equity. So if my liability is zero, then my shareholder equity would be 10,000. Does that make sense? So let's flash up on the screen a chart of accounts for my profit and loss. Let's look at some of the basic categories. You have cash in bank. You have account receivable as a current asset. Even though you may not have received it, it's still going to be booked as an asset. Then you have fixed assets, like some of my furniture fixture, my organizational costs, my furniture, things like that. My liabilities is how much do I owe? Do I have credit card debts? Do I have notes out there? Do I owe payroll that may be unpaid yet? All of those things start adding up. And then you have your equity accounts at the very bottom. And so remember, assets equal liabilities plus equity. You remember that, you know the ins and outs of a balance sheet. Everything else is learning, which you will learn at the workshop. You'll learn a lot of the basics on this stuff of what things get posted, what is an asset versus what is really a liability, things like that. You're going to get a flavor for this, and you're going to become comfortable with it. And over time, especially if you run a business, it's going to become old hat, and you're going to be laughing and saying, geez, I didn't know this, but it's actually not that complicated. It actually is fairly straightforward. Between the two, if you learn to keep a P&L and a balance sheet, you're going to be able to tell the health of your business. And I don't care whether you're a real estate investor, whether you own an ice cream shop or whatever, that's a business to me. You're going to be able to determine the health of your business. Even personally, you can apply the same principles to yourself and take a look at yourself and say, how much real estate do I own versus how much liability do I have? Do I have mortgages? We call it net worth. How am I looking on paper? Do I need to make some changes here? Am I going the right direction? Is my net worth increasing to where I need it? All those things, you're going to be able to learn to do that by the use of a profit and loss and a balance sheet. And you have those two items. It's easy to do tax work because most of the returns are prepared off of balance sheets and P&Ls, believe it or not. And two, you're always going to have a pretty good gauge of where you're at and whether or not you're actually losing money unbeknownst to you, because maybe you're increasing liabilities while maybe bringing in some cash through a line of credit or whatnot. But you're going to be able to see, hey, wait a second, my shareholder equity dropped down even though I thought I was making greater profits. And so it's not going to be lost on you anymore. The last area that I really want to address, and this is probably one of those areas that 10% of the time really gets focused on by businesses, is corporate credit and business plans. If somebody goes to the trouble of establishing and separating out a business, because there's tremendous benefits from an asset protection standpoint, estate tax, estate planning, taxation, both federal and probate fees, things like that. There's all these different benefits, and if someone goes through that, there's some other ancillary benefits that oftentimes they ignore. And one of the biggest areas is corporate credit. If you can create a separate individual, like a corporation, and make no bones about it, the law looks at that as an artificial person, and if you can establish credit in the name of that business, then it's no longer tied to you. It takes a little bit of time, but once you establish separate credit in your business, then it's going to have access to capital that you might otherwise not be able to. And let me show you the practical impact of this. We have clients that are so far underwater in their homes that sometimes they make strategic defaults. They're dealing with a lender who was not dealing in good faith. Maybe their interest rates escalated and they're not willing to negotiate. Their house has lost half its value and they're saying, geez, I need to make a strategic default, except for the fact that all of their lines of credit and all their business credit is tied to their personal credit. If only they had separated out earlier, then the credit of the business could stand on its own and their individual stuff wouldn't be impacted, and vice versa. We've seen a number of cases where businesses have struggled in recent years with the economy going down and they've had to make changes, and sometimes they're not able to pay a bill on time. And in business, it can be very unforgiving when you talk about Dun & Bradstreet or Experian Business and how they categorize the businesses, whether it's creditworthy or not. And you see lines of credit being cut and all these things, and it impacts the business. Do you want that to flow over to your personal? If you haven't separated them out, then it will. And so that's the importance of making sure that you're creating a separateness. Now your business, when it starts up, may be like a teenager that has no credit history. So you really have to have one of three things: credibility, which is a long history and showing that you've used credit intelligently in the past. You need to have collateral, like assets. And by the way, there's all sorts of things that you can use as collateral, not just things like real estate or equipment, but we've used art, we've used stock accounts, we've used all sorts of things as collateral when we're looking for funding for a business. And the last one is the most obvious, is if you have cash. Now, this is where people make a big mistake. Is quite often they'll set up a business and they'll contribute money to it. Okay, so I put $50,000 into a business. Congratulations, you've done nothing to build its separate credit. Remember, this is like a teenager with no credit history. An easy thing you could have done, which maybe it's not too late for some of you, is to take that $50,000 and invest it in a CD and then use that as collateral for a business loan. Maybe use it as collateral for a line of credit that then that business can utilize. What does it do? It establishes business credit in the name of the business. And over time, if you ever want to cash out of that business, it's much easier to cash out of a business where you don't have to rely on a third party to provide financing to cash you out. When the business has access to large amounts of capital, quite often what will happen is new ownership group comes in, the business borrows a large chunk of change and hands it off to the previous owners. That's an easy way to transfer business without involving a third party to have to fund the deal. You do that, you can walk away. Business can continue on. You're not a personal guarantor on that account, and they have to deal with the debt, and the business has to deal with the debt because it's a separate person. Now, in order to do business credit, and in order to make really any good business decisions, you need to have a business plan. And one of the things we're going to be going over in the workshop is just touching on kind of the nuances of what is in a business plan and how business plans can actually help you. It makes no sense just to dive into something without really trying to articulate something as simple as what are our objectives. I'm surprised oftentimes when I sit down with somebody and say, what is your end game really in what you're doing? Some of them may say, oh, I want to benefit a charity or I want to build wealth for my family. I understand that. Now, how much? What are your goals? What type of growth projections do you want to make? How are you planning on making money? If you're making money by flipping properties, how much do you really need to make per property? How many properties are you going to try to do in a particular year? And start writing it down. And why do you write it down? Because it makes it so. The businesses that use business plans are more often than not the ones that succeed. Businesses that don't are more often than not the ones that fail because they're not articulating. It's kind of like writing down goals for yourself. If you don't write it down and you don't articulate exactly what it is you're trying to accomplish, you may be doomed for failure. So take that little bit of step, and you're going to learn this stuff at the workshop, but take the time to really address where you're going with your business. What are you really planning to do, and what are your, be legitimate, what are my expectations? If you say I want to make $1 million in a year, then you better have a plan on how you're going to hit there. Because if you don't and you didn't have a plan, you're going to be disappointed. Or you may make mistakes. Or if you're not doing a business plan, quite often that goes hand in hand with somebody who's not keeping good business books and they really don't understand their financial well-being, and they may overextend themselves and put themselves at risk. So you want to make sure you're doing these things. And again, those are things that you're going to learn at the workshop. Okay, we've hit our 5 areas, so you're ready to go to your workshop. A lot of you guys are going to be chomping at the bit, and you may want to learn more before you actually attend a workshop, or maybe you're not able to attend a workshop right away. So let me recommend something to you right off the gate. First off, there's Asset Protection for Real Estate Investors by Clint Coons. You've already heard from Clint. In here, he lays out a lot of the strategies and asset protection techniques that are specific to real estate investors. If those of you who like tax planning, you want to catch up a little bit of it in advance, I've written a couple versions of Tax-Wise Business Ownership. The good thing about Tax-Wise Business Ownership is that there's over 100 types of deductions, along with the backup, how to take it, and the publication or some of the law and some examples to show you how you can actually take a lot of the business deductions. A lot of folks realize that this is your biggest bang for the buck when it comes to lowering your expenses, is if you can make things deductible, it's amazing at how much farther your dollars go. So anyway, thank you very much for listening. At the event, you're going to learn how to capture some of those expenses that you may well have already incurred. You're going to learn how you can do things like get tax-free income. You're going to learn things about tax-free fringe benefits and the proper use of entities to get money back into your pocket that is 100% deductible but doesn't have to be recognized as income. You're going to learn things like minimizing self-employment taxes if you're someone who owns your own business. And you're going to learn how to properly structure your affairs to maximize asset protection, maximize the effectiveness of an estate plan, minimize things like probate fees and estate taxes, and most importantly to me, minimize your tax bill. So thank you very much. Looking forward to seeing you at the event. If you want even more information, go to bossoffice.com. That's B-O-S-S office, as in where you go, .com. We have over 200 of our local radio show, The Boss Business Brief, along with many videos and lots of special reports, including updates on tax laws. If you'd like to talk to us, give us a call at 888-969-BOSS. That's 888-969-2677. And you can talk to a representative and make sure that you're taking advantage of all the tax deductions that you're entitled to receive and that your tax forms are being filed appropriately.